So you are going to take charge as the mission head for the IMF in India. Will you physically come over soon, or will you delay your arrival till this pandemic is subsided?
No, I'm very excited to go. We haven't set the date yet. The next date for us to travel to India would be in the context of what we call the Article 4 consultation, so our regular dialogue with the Indian authorities. And my hope is, if all goes well, maybe that could be in the middle of the year that we can do that with a physical presence. So I think we all have learned that doing things remotely has many advantages. But when it comes to the human interaction, it's just very important to be in the same room. And I think it creates a level of trust and confidence that is a little bit more difficult to do if you do it via video.
Yeah. So I'm quite optimistic that by the middle of the year, the vaccination program would have forged ahead quite a bit all over the world. The current vaccine shortage we see in Europe and many parts of the world, I think, is a matter of more vaccine candidates being approved and being sent to the market. And I think that process will be fully underway by the middle of the year. I mean, there are 4 or 5 vaccines now being tried out, and I'm sure they'll all be available. If that happens, and this contact intensive services start working again, a large part of the problem of economic slowdown or recession would be taken care of. But still, there would be much need to fire up the stall engines of growth all over the world. Governments have created trillions and trillions of dollars of additional liquidity, which is floating around all over the place. Stock prices are phenomenally high. I would say highly overpriced. When your 10-year yield on US government bonds is 1.1%, the discount rate that you apply to arrive at the net present value of future earnings of a company is very, very small. So it will seem to legitimize extraordinarily high valuations. So you have PE ratios in excess of 34, 35% all over the place. And this has to correct sooner or later. And when that corrects, you will have a huge problem in economies. Markets will go for a toss. People will be very upset about what happens to their savings. There will be panic. So, firstly, when do we actually exit from this excess liquidity situation, excessive accommodation? 2, is it possible to create some kind of coordination between the developed country governments when they set in motion this withdrawal from extra accommodation?
These are, I think, very important question. We just released our World Economic Outlook update a couple of days ago. And if you look at that, while we have upgraded our growth forecasts for last year or projections, and also the one for next year, where we kind of project now growth of 5.5%. But there are still large output gaps. So what we're saying is that the economies are not operating at full capacity. So we actually see 3 areas of concerns or challenges that the world is still facing. There is currently, as you're saying, there is currently this race between mutating viruses and vaccines. And therefore, uncertainty is still relatively high. And that, of course, produces short-term growth challenges, at least in many countries. So that's one, this tension between mutating viruses and the rollout of vaccines. Secondly, we're seeing incomplete recoveries. We're still estimating that this year, 150 economies in the world would have per capita income levels below 2019. And that number only declines marginally next year. So that's the second point. And then there is this great divergence, because you were talking about the global level. Should there be a coordinated response? We see a great divergence across countries and also within societies. This is driven by uneven access to vaccines and the huge differences in resources, and also the strength of the policy response. So I think at this juncture, it is probably too early to speculate about exit strategies, especially if you're thinking about like globally coordinated exit strategies.
Now we are seeing actually a big upsurge in commodity prices. The Economist commodity price index, the dollar index, is up nearly 40% over the last 12 months, which is pretty bad. Now, I mean, there could be a number of reasons. There is a shipping crisis, there is a logistical problem. The companies have taken many ships out of the system, and so people are unable to find ways to ship their stuff. That is one part of the problem. And production has come down. And so, around the world, when governments are preparing to kickstart their economies by spending big on infrastructure, people in the commodity business are foreseeing a possibility of big surge in demand, and they are hoarding commodities. They are buying up as much as they can in the hope of being able to make a quick buck when governments and other companies start buying these things. So there is a big surge in price there. If this leads to cost push inflation, that should be a source of worry. But hopefully, because this will, sort of trigger an increase in supply as well in response to increase in price, and because there is a great deal of unutilized capacity all over the place, that supply could be forthcoming to take care of that immediate inflationary bound. But still, because of the ocean of liquidity on which these all economies are floating, the risk of inflation suddenly shooting up for any small trigger is really high. So, what do you think is the inflation scenario?
Yeah, let me maybe also kind of distinguish, maybe at the global level, and then maybe we can briefly also talk about India. As I mentioned, even with the expected recovery that we are projecting at this juncture, output gaps, so the slack in the economy across the world, is not expected to close until after 2022. And when you have these large and persistent negative output gaps, in our view, at least at this juncture, inflation is expected to remain subdued during 21-22. To give you a few examples, in advanced economies, we're currently looking at the inflation projections where central bank targets are not met. As a matter of fact, we're looking at 1.5% inflation. This is for advanced economies. And when you look at emerging markets and developing economies inflation, I mean, here we're projecting inflation to be, again, this is for the globe on average, at 4% or just about 4%, which is still lower than the historical average of the group. So overall, 70% of economies are operating with inflation below central bank targets. Now, when it comes to India, I think maybe one thing to highlight, we did a study last year that looked a little bit of how the flexible inflation targeting framework has helped India. And actually it has anchored based on our study inflationary expectations. So that's very, very important. But if you look a little bit ahead and maybe abstract from some of the surprises that we have seen, in general, one would think lower food price inflation and the lagged effects of muted demand are expected to have some moderating impact on inflation over the short term. At the same time, core inflation remains elevated despite the moderation. And as you highlighted, there are these factors, higher input costs from prices of petrol and diesel at the pump, and also strengthening demand are likely to moderate the slowdown in core inflation. So I think for India, in summary, although overall inflation is expected to moderate in 2021, inflationary risk for any broad-based cost push factor need to be closely monitored.
I'm coming back to inflation. Our own projections are actually very, very conservative. The GDP deflator that the Central Statistical Office puts forward is something like 3.9 for the next year, 3.9%. The consumer price index, according to the central bank, the RBI, in its latest monetary policy forecast, is something like 5%. So, by global standards, 5% might seem quite a bit, but by Indian standards, 5% is fairly okay. But it is all this, extra liquidity sloshing around the system, which seems to present a risk of, suddenly prices going up. There is something in the current situation which allows the excess liquidity to show up only in asset prices and not in commodity prices. Now, why do you think this is the case? Why are only asset prices going up and commodity prices, goods prices, and service prices staying low?
Yeah, I think again it has to do with the fact that we still have a lot of slack in the economy. Correct? We're still not at the level of output as we were before. And I think that's true in India and that's true globally, correct? So parts of the economy are not operating at full capacity, and that is part of the factor that moderates inflationary pressures.
Now, India is budgeting for a big growth. We have a big plan to attract global capital in our what we call monetized assets, infrastructure assets. We plan to have our built-up airports, toll highways, anything that is worthy of, eliciting investor comfort. We are going to monetize them and ask people to buy the revenue streams coming from these assets so that the money so released can be redeployed into fresh investments. The idea being that fresh infrastructure investments are risky and external investors might not be very comfortable putting their money there, whereas something that is already built up, working and generating revenue, they'll be only too happy to buy into. And once they part with that capital, that can be used by the government to mitigate risk and start new projects. Now, this is one part of the scheme. We are trying to fix our broken credit mediation system. Banks are being recapitalized. The non-performing assets are being bought off their books and being transferred to a bad bank. So the banks will be freer to start lending. So all these things are in place. Now, but the fact is that for the last 6-7 years, the investment rate for India has been some 6 percentage points below where it routinely had reached in the first decade of the 21st century. It used to be some 33%, now it's below 27%. China, when it grew really fast, it had investment rates well in excess of 45%, and it would even cross for 50%. Now, I would imagine that if India were to really grow fast and generate the kind of jobs that its people need, we also will need to push up our investment rate at one place. But we are not a directed economy where the government can wave a wand and investment will take place. So, what are the kind of policies that India should follow to ensure that we have the kind of investment and the growth and the job creation that we need?
I mean, I think, first of all, to start out, I think, the potential for India's economy to continue to grow at high and sustainable levels are very good. But as you highlight, the key is to eliminate some of the bottlenecks. And as a matter of fact, we presented a regional economic outlook in November 2019 in Delhi, where we kind of highlighted some of the issues that need to be addressed. And I think, forgetting about the COVID shock, all of these issues are still relevant. And I think you already highlighted a few of them. Critically important is the financial system, correct? Because in order to channel, scarce savings to the most productive part of the economy, you need a functional financial system. And so anything that strengthens, as you pointed out, recapitalization, for example, is critically important. But the flip side of this, and I think this is, of course, where the COVID shock maybe amplified the challenges, is the corporate sector. Some of the corporates have high debt levels, so these need to be sorted out, resolved. And for that, you need to continue on strengthening the frameworks to deal with bankruptcies, maybe out of court resolution, especially for small and medium enterprises. Because again, as long as companies are saddled with high levels of debt, they're not going to operate as efficiently as they could. And then the last point that you're making, there is, of course, a big role for government also to play, and through public infrastructure investment. I think the beauty about public infrastructure investment in the current context is it does two things. On the one hand, it can be another boost for the economy, sort of like this short-term cyclical part, but it ultimately then overcomes bottlenecks. And I think here, in a context of, there's only so much fiscal space the country has, I think the idea to look at the portfolio of assets that the government owns and maybe to restructure it, I think that's what you were alluding to as well. I think it's quite important. There are certain things that the Indian government has on its balance sheet that it owns that could probably easily be done by the private sector. So commercially viable companies can be divested, can be passed on to the private sector. And that would then allow you and give you the space to strengthen your public investment, where maybe the private sector is a little bit more reluctant to investing. So it is sort of like a change in the composition of assets, and that could be quite useful in the current context. But I think the emphasis on public infrastructure investment is critically important to overcome the bottlenecks and then to facilitate the operation of the private sector.
This is not just India's problem. I mean, India needs capital for its infrastructure. But if you look at the developed West, where the population of people who are going to retire and who need their pensions to be paid, who need their investments to generate adequate returns, they are unable to find assets which can yield predictable, reasonable, high rates of return. They just invest in government bonds; they'll get 1% or even less in the advanced countries. So they have to move to countries like India, which are still capable of growing, which are still capable of generating decent returns. Now, the problem is of actually trust. I mean, if you put this money here, what is the guarantee that you will get a return? What is the guarantee that corporate governance standards are sufficiently high to ensure that the money will actually be put to good use and rather than wasted? What are the standards of accounting and reporting so that what the numbers that you see are actually credible? Now, is there some way of actually putting all these pieces together? I'm sure there are things which can be done only at the level of the country, and international agencies cannot really help there. But there are certain other kind of things where global agencies can in fact help, and these are things that need to be, like, for example, fixing this tax leakage. Our fiscal problems are made worse by the fact that the tax collections as a proportion of GDP is nearly 16.5% of GDP, which is less than half the average for the OECD. So the leakage in taxes, I'm sure we'll do quite a bit on our own if we fix our GST and follow up the audit trail generated by this wonderful tax, and we'll be able to lay our hands on both direct as well as indirect taxes. But at the same time, this corporates being able to do very clever tax planning and shift their profits out of the jurisdictions where this profit is generated, that's a very major problem which can be tackled only at the global level. Now, OECD has some, wage erosion and profit shifting kind of schemes. What is the IMF's own role in helping countries realize the taxes they are due?
No, I mean, you raised a lot of important questions. Maybe the point on mobilizing revenues. I think maybe the good news for India is there is actually quite a bit of room to strengthen revenue mobilization by eliminating the loopholes and so on and so forth. So we did a study on this, and it demonstrated that there's a lot that can be done. You just mentioned GST. But that's good news, because it means that you can raise revenue collection without having to raise taxes. So I think that's very good. When it comes to credibility, I think that's critically important. And for any country, it starts with the government. So, one of the experiences that we have from other countries, the importance of having a medium-term budget framework. Again, that's the basis for everything, because everything is benched off of government yield curves and so on and so forth. So certainty about that in communication of what the strategy is, I think can be very helpful. And the last point you're making, this is an area where the IMF is actively promoting collaboration at the global level, and that is exactly to deal with the issue of tax evasion at the global level. And so this is where we're trying to create a fora and do the analytical work to demonstrate that this needs to be done at the global level and in a coordinated fashion.
No, at the IMF, you deal with a variety of countries. I'm sure you would have worked with different kinds of countries. There are countries where credit is not something that is very appetizing. If you look at many Latin American countries, because of very levels of high inflation, there is a tendency to avoid credit because you never know what you'll end up with. But India is a country that has been accustomed to credit for centuries. I don't know if you've heard the story. We used to have this thing called a hundi. We don't have formal banks, but there were hundis. It is like if I issue, it's like a bank note. If a merchant holds a hundi on another merchant, that hundi holder can go to that other merchant who will honor that hundi and take his money out for whatever is that hundi worth. So the tale is that a king was laying siege to a rival king's capital city when he ran out of money to pay his soldiers. But he had a hundi on a merchant inside that kingdom, inside that city, which was being laid siege to. And they wanted a cessation of hostilities to allow the merchant to honor that hundi. And the story is that the king allowed his merchant to honor that hundi so that he would pay the money for his enemy's soldier to continue with the attack. So this might be a purely acapella story, but the point is that you have a tradition of credit in this country that goes back to many centuries.
Mm-hmm.
And today we are in a situation where total bank credit to the commercial sector is only 50% of GDP, which I find ridiculous. There is no decent market economy anywhere in the world where bank credit is less than 100% of GDP. It is 120 to 200%, etc. in most countries. And how is it possible that India is growing as fast as it has been, with bank credit only servicing 50% of the GDP credit needs? So my strong feeling is that the pool of informal credit is so large, which is not really recognized in official accounting. The story that you tell about how much credit is going around, that the scope to formalize credit is far more than what we really accept or acknowledge. And that fintech is likely to play a huge role in allowing people who cannot access formal credit today to be assessed and their credit worthiness ascertained and to be made eligible for credit. So I think while a body like the IMF is not really bothered about individual credit and the systems of accessing individual credit histories, since they aggregate to a very large proportion of the total credit and the monetary system of a country, perhaps you should take a look at how fintech has a potential to transform the way banking systems work in emerging countries like India.
No, again, I think your point is very well taken. And here, I think if you look across the world, you have India and other countries, it seems that some of the developing and emerging markets are almost ahead of some of the advanced economies in the use of fintech technology, and have been leapfrogging and mobilizing resources that way. I think your point is very well taken that in the problem, I think, in developing countries in general is that information is costly, scarce. And when you are in the financial system, whether you're a banker or in capital markets, you need to have information about the quality of the project investment and the behavior of your consumers. Now, traditionally, banks have a comparative advantage, overcoming what we call asymmetric information. I think fintech here can play a critical role to do credit assessment in real time, and can really be a game changer. I think the key here is to ensure that as the industry continues to advance, that the regulation and frameworks are also strengthened at the same time, because you don't want to have any hiccups going down the road. So again, I think here India is an example, and we've seen that also. I think when it comes to technology, even in the context of the crisis, what is it that we have learned? And that is that actually governments can mobilize technology to get resources very efficiently to those who need it the most. So this is, I think, actually one of the lessons from the crisis, that there are significant benefits to rely on the technology, and that is probably where more could be done. Or if you come to technology, another example is, e-filing of tax returns. Again, you don't have to go and do it in a physical form. But yeah, coming back to the financial system, I think there's a lot of scope to bring the informal sector into something that is more formalized. Fintech can play an important role. It allows asymmetric information to be overcome. The key, of course, is, like with any financial innovation, you have to make sure that the regulation also keeps up, so that down the road there is no fraud, and that people suddenly lose confidence. And I think that's what you were talking about in the first place.
Now, during the course of the pandemic, the IMF had put out a cautionary note on the potential of the pandemic to increase inequality significantly. Now, inequality is widening, especially of one particular kind. Those who have regular jobs which can be transacted from home, and those who actually need to be physically present at a work site to do the work. And the pandemic has sort of crippled one section, while the other has been virtually unaffected, practically. Now, this has created another layer of inequality. The global discourse on inequality does not adequately recognize that in a country like India, more than inequality, what matters is that the absolute levels of poverty. If you can take people out of poverty, that actually dehumanizes them, that prevents them from accessing their potential as productive human beings. That is more important than actually reducing the level of inequality in a country like India, where many people live below subsistence. That being part of the necessary corrective that the general discourse on inequality must take into account. The fact remains that the potential of a thing like the pandemic or a bad recession to widen inequality while depressing the incomes of those at the bottom of the pyramid is significant. Now, the way the governments have sought to tackle it is by creating huge amount of increase in the fiscal deficit by borrowing and trying to provide some kind of support, temporary support to their citizens. This beyond a point is not sustainable. So what is the way out of this kind of a problem?
No, you highlighted that the IMF has actually done some work on this, and And the insights of our work clearly shows that the pandemic has disproportionately impacted labor markets across demographic groups. So who are those? I think women, this is at the global level, women have been adversely impacted, informally employed, workers with lower educational attainment, in some cases also the younger. What we have seen is that the ability to work from home has been key during the pandemic. And, the study shows that the ability to work from home is lower among low-income workers than for high-income earners. That's not surprising. And then another study that focuses, this is data on the United States, shows that sectors with activities more likely to perform from home saw a smaller reduction in employment. So if you take those two factors combined, it suggests that lower income workers were less likely to be able to work from home and more likely to lose their job. And that, of course, would worsen the income distribution. The other one is, and this is another study that we have, that demonstrates that from this pandemic, that the impact on the poorest will be larger than in any other pandemic before, and will expect the Gini coefficient to worsen quite a bit. Now, the IMF has argued that, especially during the pandemic, it is important to provide support to those who are impacted the most vulnerable. And here, I think the Indian government, has of course addressed some of these issues by enhancing social protection, in-kind support, cash transfers, insurance coverage, and employment support for through the rural employment guarantee schemes. So I think, in general, while we're still coming out of the pandemic, it is important to continue providing support to those, because one problem is once people have been out of the labor market, whether it's informal or not, you're losing skills, and that ultimately then has implications for the future, and undermines your growth potentials.
Yeah. So, Alfred, one thing that has changed over the years is an ideological view of the legitimate role of the government in the economy. It used to be pretty confirmed within the IMF and various other circles that the government should stay out of business, that its job is to function as an enabler. It will provide macroeconomic stability, it will create policies that allow economic agents the freedom to operate, but it will itself not get into active roles in the economy. But ever since the global financial crisis, it has been pretty clear that governments are meant to play an active role. They have to, rescue banks and companies. They have to arrange swap lines if there is a foreign exchange shortage. They have to offer support to troubling companies and avoid distress by stepping up special ad hoc relief measures. There are very many things that the government is encouraged to do, the government is expected to do, and for that, governments have actually borrowed heavily, widening their fiscal deficit. In the case of the US, up to more than, say, 15-16% of GDP. So this is how things have been. So the ideology that the government should stay away from the economy no longer holds true. I suppose you would concur, or would you like to say something else? The second thing is about globalization. After Brexit, after US President Trump's attempts to play a solitary role to make America great again, cutting itself off from mainstream multilateral engagements, including the WTO, there was a fear that globalization has played out, that globalization has run out of steam. But now it would seem that the pandemic itself is a result of globalization. The vaccine development is a highly globally coordinated development. You will find that uh, many countries are trying to coordinate their responses in terms of stimulus. So globalization is also far from dead, actually fully alive and kicking. Uh, what are your views on these two subjects?
So I think we have learned, we know from before that active fiscal policy to smooth the business cycle is very much warranted. But as we come out of the COVID, I think it is also important that countries ultimately then go back to focusing on consolidating their fiscal position, because ultimately we have seen that debt levels across the globe have gone up significantly. So that, I think, at some point will become quite urgent. But that doesn't mean that the government doesn't have a role. I think, in particular, what we have seen is, and that goes back to credibility, transparency, and for the private sector to be able to make sound decisions about future investments, is to strengthen frameworks, correct? Whether it is budget frameworks, medium-term budget framework, whether it's in the financial sector to strengthen financial sector regulation, whether it's, as you pointed out at the very beginning, in terms of the quality of data, correct? So if investors have good information about the performance of a company, it's a lot easier to mobilize resources. If that information is poor, then it's a little bit more tricky. The problem, I think, with these type of government investments that deal with frameworks, financial sector regulation, governance structures, they are a lot more difficult to communicate to the public.
Yeah. So thanks a lot, Alfred. Uh, I hope we will be able to meet physically when you do land up in Delhi, and we will be able to have many more such conversations.
Pleasure, and I promise you, when I do come, it will be a pleasure to meet you again, and thanks for having me.
Yeah. Thank you.
Thank you very much. Now.
Yeah. Have.